I am not a financial advisor, and this video is for educational and informational purposes only. The information presented here is not intended to be a substitute for professional financial advice. You should not act or refrain from acting on the basis of any content included in this presentation without seeking financial or other professional advice. Always consult with a qualified professional before making any financial decisions. Imagine it's 2006. A part-time dog walker in Miami, with no savings and a spotty credit history, walks into a mortgage broker's office. On the application, they write down that they make $150,000 a year. The broker doesn't ask for a single pay stub, no tax returns, no W-2s. They just nod, smile, and a few weeks later, that dog walker is handed the keys to a $500,000 condo. This isn't a scene from a movie. This was the reality of the no-doc mortgage, the infamous liar loan, that became the gasoline poured on the bonfire of the 2008 financial crisis. It was a system built on a complete fantasy, a house of cards so massive that when it finally collapsed, it triggered a global economic heart attack. We all know how that story ended. Foreclosures, bankruptcies, a recession that scarred a generation. The government stepped in, new laws were written, and the no-doc mortgage was supposedly banished forever, locked away in the history books as a cautionary tale of greed and delusion. So here's the billion-dollar question: do they still exist? Can you today in the United States walk into a lender and get a mortgage without showing proof of your income? The answer is a shocking and very complicated yes. But, and this is the most important but you will hear all day, they are an entirely different animal from the financial weapons of mass destruction that blew up the economy. They are not for everyone. In fact, for most people they are a terrible idea. But for a very specific type of person, the entrepreneur, the freelancer, the small business owner, the gig worker with a complex but perfectly legitimate financial life, they can be the one and only key that unlocks the door to homeownership. Over the next few minutes, we are going to pull back the curtain on the most misunderstood, most controversial loan in America. We're going to demolish the myths and expose the truth. You'll learn what a modern no-doc mortgage really is, who they are actually designed for, why they came back from the dead, and the 5 critical red flags you must look for to avoid getting scammed or trapped in a financial nightmare. If you have income that doesn't fit neatly onto a W-2, if you've ever been told no by a traditional bank despite making good money, this is the information you've been searching for. To understand how we got here, we have to go back to the beginning. Because these loans weren't born out of pure evil. They were actually created to solve a real problem. Think about it. Who has trouble proving their income? A seasoned real estate investor who lives off rental income. A restaurant owner whose profits fluctuate wildly from month to month. A highly paid consultant who gets paid in lump sums from various clients. For these people, a traditional mortgage application is a nightmare. Their tax returns, designed to legally minimize their tax burden, often don't reflect their true cash flow. They look poor on paper, even if they're earning a fortune. So the banking world created a solution: the stated income, stated asset, or SISA loan. It was based on a simple premise of trust. The borrower would state their income, the lender would take them at their word, and the loan would be approved based on other factors like a massive down payment and a stellar credit score. For a while it worked. It was a niche product for a specific high-quality borrower. The lender took on a bit more risk, so they charged a higher interest rate and everyone was happy. But then, something shifted in the early 2000s. Wall Street got hungry. They discovered they could bundle these mortgages together into complex financial products and sell them to investors all over the world, making billions in the process. Suddenly, the demand for mortgages exploded. The pressure was on to write more loans faster with less oversight. The niche product for the wealthy self-employed borrower was about to go mainstream in the worst possible way. The stated income loan morphed into the liar loan. The guardrails came off. Lenders, pushed by their bosses to hit insane quotas, stopped caring if the stated income was real. They were no longer holding the risk. They were just selling the loans up the food chain as fast as they could. It became a giant game of hot potato, and nobody cared if the potato was actually a live grenade. The stories from that era are legendary. You had strawberry pickers claiming the income of surgeons. You had unemployed people getting approved for mansions. Mortgage brokers were actively encouraging applicants to inflate their income, whispering, "Just tell us what you need to make to qualify." It was the honor system, but the entire class was cheating, and the teacher was handing out the answer key. Why? Because every fraudulent loan that got approved meant a commission check for the broker and a bonus for the banker. The long-term consequences were someone else's problem. We all know what happened next. The music stopped. When interest rates on these risky loans reset, borrowers who had lied about their income couldn't afford the new, higher payments. They defaulted. 1 by 1, then 10 by 10, then 100,000 by 100,000. The dominoes began to fall. The financial products built on these mortgages were revealed to be worthless. Banks collapsed. The stock market cratered. The Great Recession began. In the ashes of that crisis, Congress passed the most sweeping financial reform since the Great Depression, the Dodd-Frank Act. And buried deep inside that massive law was a simple, powerful new rule called the Ability to Repay, or ATR rule. It was a sledgehammer aimed directly at the heart of the liar loan. The rule mandated that for virtually all residential mortgages, lenders had to make a reasonable, good faith effort to determine that the borrower could actually afford to pay back the loan. No more fantasies. No more taking the borrower's word for it. Lenders now had to verify income using reliable third-party records, like tax returns, pay stubs, and bank statements. The no-documentation mortgage, as the world knew it, was dead and buried by federal law. So if the law explicitly requires lenders to verify income, how can a no-doc loan possibly exist today? How are lenders getting around one of the most important financial regulations of the 21st century? The answer lies not in breaking the law, but in a giant, gaping loophole built into the law itself. A loophole that created an entirely separate universe of lending with a different set of rules for a very specific type of borrower. And understanding that loophole is the key to understanding the new world of no-doc lending. That key, that loophole, is elegantly simple and incredibly powerful. It all comes down to two words: business purpose. The entire Dodd-Frank Act, the qualified mortgage rules, the ability to repay standard that killed the old no-doc loan, all of it was designed to protect the average American consumer buying a home to live in. The law applies to consumer credit. But what about loans that aren't for personal, family, or household purposes? What about loans for a business? The law is largely silent. Congress essentially drew a massive, bright line in the sand. On one side, you have consumer mortgages for your primary residence. These are now the most heavily regulated financial products in the country, and for good reason. Lenders on this side of the line must verify your income. They have to pore over your tax returns, your W-2s, your bank statements. They have a legal fiduciary duty to ensure you have the ability to repay that loan. No exceptions. Failure to do so exposes them to catastrophic lawsuits and regulatory fines. This is the world of the qualified mortgage, or QM loan. It's safe, it's standardized, and it's rigid. But on the other side of that line is the world of business and commercial lending. And in this world, the rules are fundamentally different. The government's logic was this: if you're acting as a business entity or an investor, you're considered a sophisticated party. You're not just a family trying to buy a home. You're an entrepreneur making a calculated investment. You're expected to understand the risks. Therefore, the lender doesn't need the same level of hand-holding and protection mandated for consumer loans. This means the strict ability to repay rule doesn't apply. Let that sink in. The very rule that killed the no-doc loan for your primary home simply does not exist for loans taken out for a business purpose. This exemption created a parallel financial universe, a place where lenders could once again originate loans based on common sense and asset performance, rather than a borrower's personal tax returns. And the primary vehicle for this new universe, the most popular and revolutionary product to emerge, is something called a DSCR loan. DSCR stands for Debt Service Coverage Ratio. And if you remember nothing else from this video, remember that acronym. It is the engine of modern real estate investment for the self-employed and the entrepreneurial. So what is it? A traditional mortgage asks the question, can the person afford this loan? A DSCR loan asks a completely different question. Can the property afford this loan? The entire underwriting process is flipped on its head. The lender is not primarily concerned with your personal income. They don't care if you're a freelance web developer with wildly fluctuating monthly paychecks, or a restaurant owner whose tax returns show a modest profit after all your business expenses are written off. What they care about is the cash flow of the property you are buying. Let's make this real. Meet Sarah. Sarah is a brilliant freelance marketing consultant. She clears over $200,000 a year in revenue. But after paying for her software, her assistants, her marketing, her home office, and taking every legal deduction her accountant can find, her tax returns show a net income of only $60,000. She's smart with her business, but to a traditional mortgage lender, she looks like a high-risk borrower. She goes to a big bank to try and buy her first rental property, A duplex she found in a growing neighborhood. She shows them her bank statements flush with cash. But the underwriter just shakes his head, points to her tax returns and says, "I'm sorry, your debt-to-income ratio is too high based on this $60,000 figure." Sarah's crushed. She has the money, she has the ambition, but the system is designed to punish people exactly like her, people who are self-employed. Then, a mortgage broker tells her about a DSCR loan. It's for an investment property, so it qualifies as a business purpose loan. The lender doesn't even ask for her tax returns. They don't ask for pay stubs. Instead, they ask for two things: a copy of the lease agreements for the duplex, and an appraiser's opinion on what the market rent for the property is. The appraiser confirms that each unit in the duplex can reliably rent for $2,000 a month, for a total of $4,000 in monthly gross rental income. Now comes the math, and it's simple. The lender calculates the total monthly housing payment for the property. This is what's known as PITI: principal, interest, taxes, and insurance. Let's say for Sarah's duplex, that total monthly payment comes out to $3,200. The debt service coverage ratio is simply the gross rent divided by the PITI. So for Sarah, it's $4,000 divided by $3,200. That gives you a ratio of 1.25. This number, 1.25, is the magic key that unlocks the loan. What it tells the lender is that for every $1 the property costs to own each month, it brings in $1.25 in revenue. The property isn't just self-sufficient, it's profitable. It generates a 25% cash flow cushion right off the bat. The lender's risk is no longer tied to Sarah's volatile freelance income. Their risk is tied to the stability of the local rental market. As long as that duplex can be rented, the loan can be paid. The property itself is the qualifier. This is a complete paradigm shift. For millions of real estate investors, entrepreneurs, and gig economy workers, the DSCR loan was a revelation. It allowed them to be judged not by their W-2s, but by their ability to find a good deal. It rewards investment savvy over traditional employment. Lenders who specialize in these loans will have different requirements. Some might be okay with a DSCR of 1.0, meaning the property just breaks even. Others, for a better interest rate, will want to see a 1.25 or even a 1.5. Some lenders will even approve a loan with a DSCR below 1.0, meaning the property loses a little money each month. They'll do this for borrowers with high net worth and significant cash reserves, who are betting on the property's appreciation to create their return, not its monthly cash flow. The property is the borrower. Your personal income documentation is irrelevant. This is the new no-doc mortgage. It exists, it is thriving, and it is a 100% legal and legitimate product, all thanks to that business purpose exemption carved out of the post-2008 financial regulations. It's a world built on logic and cash flow, not tax forms. But this only solves the problem for investors like Sarah, people buying rental properties. What about the millions of other self-employed people? The small business owners, the consultants, the startup founders who aren't looking to be landlords, but simply want to buy a home for their own family to live in? A DSCR loan won't work for them because a primary residence is, by definition, a consumer loan, not a business purpose loan. So for them, does the no-doc mortgage truly remain a ghost? A relic of a bygone era? Well, not exactly. Because while the DSCR loan was being perfected for investors, another set of lenders was quietly creating a different kind of product for a different kind of borrower. A product that sails even closer to the old ways, using bank statements instead of rent rolls, to open the door to homeownership for the entrepreneurs who were left behind. This new breed of loan is called a bank statement loan. And for millions of self-employed Americans, it's not just a product, it's a lifeline. To understand why it's so revolutionary, you first have to understand the quiet crisis that's been brewing for over a decade in the American housing market. It's a crisis born from a simple, fundamental mismatch. The way we work has changed, but the way banks lend money hasn't. Think about the traditional mortgage application. It's a world built for one person, and one person only. The W-2 employee. The person who gets a steady paycheck every 2 weeks, with taxes automatically withheld. Their income is predictable, clean, and easy to verify. The entire system, from the application forms to the underwriting software, is engineered around their financial life. You show your pay stubs, you show your W-2s from the last 2 years, and the bank's calculator spits out a number. Simple, clean, predictable. But what about the freelancer? The small business owner? The consultant, the YouTuber, the real estate agent, the gig economy driver? Their financial life is the polar opposite of clean and predictable. Their income might come in massive, irregular chunks. They might have a phenomenal $60,000 month followed by a lean $8,000 month. They don't have pay stubs. They don't have a W-2. They have 1099s, invoices, and a constant churning flow of money in and out of a business account. And here's where the system completely breaks down for them. It's what I call the tax return trap. Every single accountant in America gives their self-employed clients the exact same advice, and it's excellent advice. Write off everything. Every legitimate business expense you have, you deduct it from your gross income. Your new laptop? Write it off. The portion of your home you use as an office? Write it off. Your marketing budget, your software subscriptions, your business travel, your client dinners? Write it off. Write it all off. Why? Because it legally and intelligently lowers your taxable income, meaning you pay less to the IRS. It is the smart, responsible thing to do as a business owner. But when that same business owner walks into a bank to get a mortgage, that smart, responsible decision becomes a financial suicide mission. The mortgage underwriter doesn't care about your gross revenue. They don't care about the $150,000 that flowed through your business account last year. They look at one number and one number only: your adjusted gross income, or AGI, on your federal tax return. That's the number after all those smart, responsible write-offs. Let's make this real. Meet Sarah. Sarah is a brilliant freelance graphic designer. Last year, she billed her clients a grand total of $200,000. A fantastic year. She's at the top of her game. She lives comfortably, saves aggressively, and has a stellar 780 credit score. She has 20% to put down on a beautiful $600,000 home. By all real-world metrics, she is a prime borrower. A safe bet. But then Sarah hands over her tax returns. Her accountant, being very good at his job, helped her write off $80,000 in legitimate business expenses. New computer equipment, expensive design software, marketing, a co-working space membership. So her taxable income, the only number the bank cares about, isn't $200,000. It's $120,000. The bank plugs that number into their rigid formula, and the computer says no. Or even worse, the computer says yes, but only for a $300,000 condo. Sarah's crushed. She knows she can afford the monthly payment on the bigger house. Her actual cash flow proves it. She's been paying more than that in rent for years. But the system, the rigid, unthinking W-2 obsessed system, has branded her as unqualified. She's been punished for being a successful entrepreneur. This exact scenario plays out hundreds of thousands of times a year, all across the country. It's a silent barrier locking out some of our most ambitious and productive citizens from the dream of homeownership. This is the problem that the bank statement loan was designed to solve. The lenders who offer these loans, again typically smaller, more agile non-bank lenders, made a revolutionary decision. They decided to throw out the tax return. They recognized that for a self-employed person, a tax return isn't a reflection of their ability to pay a mortgage. It's a reflection of their ability to hire a good accountant. So, instead of asking for tax returns, they ask for something far more representative of actual cash flow: 12 or, more commonly, 24 months of business bank statements. They don't care about your write-offs. They want to see the real money coming in and out of your business month after month. But how do they turn those raw deposits into a qualifying income? They can't just assume every dollar deposited is profit. Businesses have expenses. So they use a simple but brilliant system. They look at all the deposits over the 24-month period and they do one of two things. Option 1 is to meticulously add up all the deposits and then have the borrower provide documentation proving their actual business expenses, which they then subtract. This can be cumbersome. So the more common method, option 2, is to apply a standard expense factor based on the type of business. For a service-based business like Sarah's graphic design company, where overhead is low, the lender might assume her expenses are, say, 30%. They take her total deposits, subtract 30%, and the remaining 70% becomes her qualifying income. For a business that sells physical products and has to buy inventory, the expense factor might be higher, maybe 50% or 60%. Let's run the numbers for Sarah again. She deposited $200,000 into her business account. The bank statement lender applies a 30% expense factor, leaving her with a qualifying income of $140,000. That's $20,000 more than what her tax return showed. Suddenly, that $600,000 house is back on the table. The door that was slammed shut by the traditional system has been pried back open. This isn't a loophole. It's just logic. It's a common-sense approach to underwriting for a modern workforce. It's an acknowledgement that the person who builds a business from scratch deserves the same access to the American dream as the person who works in a cubicle. Now you're probably thinking, what's the catch? There's always a catch. And you're right. These are not government-backed Fannie Mae or Freddie Mac loans. They are non-qualified mortgages or non-QM loans, which means they fall outside those ultra-strict federal guidelines. Because the lender is taking on a perceived higher risk by not using tax returns, they protect themselves in other ways. First, the interest rates are higher. You're not going to get the absolute rock-bottom rate you see advertised on TV. You can expect to pay anywhere from 1 to maybe 3 percentage points higher than a conventional mortgage rate, depending on your qualifications. It's the price you pay for the flexibility. Second, you need a significant down payment. The days of 0 down or 3% down on these types of loans are long gone. Most bank statement programs require a minimum of 10%, and a 20% or even 25% down payment is far more common and will get you a much better rate. The lender needs to see that you have serious skin in the game. And third, this is crucial, your credit score still has to be solid. This is the key difference between today's non-QM loans and the toxic subprime loans of 2008. Those old no-doc loans were often given to people with terrible credit. Bank statement loans are for people with good credit, often great credit, who just happen to have a non-traditional income structure. Lenders will typically want to see a credit score of 680 or higher, and the best programs are reserved for those with scores well into the 700s. So, the bank statement loan is not a free-for-all. It's a specific tool for a specific type of borrower, the creditworthy, successful, self-employed individual who has been unfairly sidelined by the traditional lending system. It's a recognition that the American economy is no longer a monolithic world of W-2 employees, and the financial industry is, slowly but surely, starting to adapt. We've seen how investors can use DSCR loans to qualify based on a property's income. We've seen how entrepreneurs can use bank statement loans to qualify based on their business's real cash flow. But what about everyone else? What if you're just a regular person with a regular job but something in your file is complicated? Maybe a recent bankruptcy, or a short sale from years ago that still haunts your credit report. Are there still options for the person who simply doesn't fit into the perfect little box that conventional lenders demand? The answer to that is where the world of non-QM lending gets even more interesting. So let's peel back the curtain on this new world. To understand how we got here, we have to go back to the smoking crater of the 2008 financial crisis. When the dust settled, lawmakers and regulators were asking one question: how do we make sure this never, ever happens again? The answer, in large part, was a sweeping piece of legislation called the Dodd-Frank Wall Street Reform and Consumer Protection Act. It's a mouthful, I know, but inside that massive law was a tiny, powerful seed that would change the mortgage industry forever. It's called the Ability to Repay Rule, or ATR. The ATR rule is deceptively simple in its concept. It mandates that before a lender gives you a mortgage, they must make a reasonable and good faith determination that you, the borrower, have the ability to actually pay it back. It sounds like common sense, right? Like, shouldn't they have been doing that all along? Well, that's the punchline. In the pre-2008 frenzy, that fundamental check was often ignored. Lenders were selling loans so fast, packaging them up and shipping them off to Wall Street, that they didn't care if the borrower could actually make the payments. The ATR rule put a stop to that. It made it illegal to issue a mortgage without first verifying the borrower's ability to handle the debt. And with that one rule, the classic true no-doc loan was killed. It was dead on arrival. Think about it. How can a lender make a good faith determination of your ability to repay if they don't look at your income, your job, or your assets? The ninja loan, no income, no job, no assets, became legally impossible. It was a direct violation of federal law. For a while, it seemed like the door had been slammed shut on anyone who couldn't produce 2 years of perfect W-2s and a pristine credit score. The pendulum had swung from one extreme, giving a loan to anyone with a pulse, to the other, only lending to the most financially perfect applicants. But the market, like nature, abhors a vacuum. The demand didn't go away. Millions of capable, creditworthy Americans were still being left out in the cold. The self-employed business owner whose tax returns, full of legitimate deductions, showed an income of only $40,000 a year, even though they were depositing $500,000 into their bank account. The retiree sitting on a $2 million investment portfolio but with no job to speak of. The real estate investor who wanted to buy a rental property based on its own cash flow, not on their personal salary. This is where innovation began. A new breed of lenders operating in a space called non-qualified mortgages, or non-QM, started asking a different question. The law says we have to verify the ability to repay. It doesn't say we have to verify it with a W-2 and a tax return. What if there are other ways? What if we could use alternative documentation to prove income? This was the birth of the modern low-doc or alt-doc loan. Notice the name change. It's not no-doc anymore. It's about using a different but still valid set of documents. It's about looking at the complete financial picture, not just the two-page summary that IRS gets. So let's break down exactly what these new loans look like, because this is where the real value is. The most popular and revolutionary of these is the bank statement loan. This is the holy grail for the self-employed, for freelancers, for gig workers, for small business owners. For anyone who's ever sat across from a loan officer, slid their tax return across the desk, and watched the lender's face fall. You know the feeling. You made great money, but your brilliant accountant did their job and used every legal deduction to lower your taxable income. Great for tax season, terrible for getting a mortgage. A bank statement loan completely sidesteps that problem. Instead of your tax returns, the lender asks for 12 or, more commonly, 24 months of your business or personal bank statements. They don't care about your deductions or your write-offs. They care about one thing: cash flow. They will analyze all of your deposits over that period to determine what your actual, real-world monthly income is. Here's a simple example. Let's say you're a freelance graphic designer. Over 24 months, you consistently deposit about $15,000 into your business account each month. After you pay for software, marketing, and your co-working space, your tax return might only show a net income of $5,000 a month. A conventional lender sees that $5,000 and says, sorry, you can't afford the house you want. But a non-QM lender using a bank statement program looks at the $15,000 in gross deposits. They'll apply a standard expense factor, say 50%, and qualify you based on a monthly income of $7,500. Suddenly, you're in a completely different league. You're being judged on the health of your business, not on your tax strategy. This one product has unlocked homeownership for an entire class of entrepreneurs that the traditional system had locked out. Next up is another brilliant solution for a different kind of borrower: the asset qualification loan, sometimes called an asset depletion loan. This is for the people who are asset-rich but income poor. Think about a recent retiree who just sold their company for a few $1,000,000. They have no job and no W-2 income. They're living off their investments. Or maybe it's a younger person who received a large inheritance. A conventional lender would look at their application and see zero income and deny them instantly. An asset qualification lender, however, looks at their brokerage account, their 401k, their savings. They see the wealth, and they have a method to turn that wealth into qualifying income. They'll take your total liquid assets and divide them by a certain number of months. It could be 60, 120, or even the full 360 months of a 30-year mortgage. That result becomes your monthly income for qualification purposes. Let's run the numbers. Imagine a 65-year-old couple with $1.2 million in a retirement account. They have Social Security, but not enough to qualify for the home they want to retire in. An asset depletion lender could take that $1.2 million, divide it by, let's say, 180 months, and boom, that's over $6,600 in qualifying monthly income. They are using the proven existence of wealth to satisfy the ability to repay rule. It's a logical, common-sense approach that allows people to leverage their life savings to buy a home without having to liquidate their entire portfolio and pay massive capital gains taxes. But what if you're a real estate investor? You're not trying to buy a home to live in. You're trying to build a portfolio of rental properties. This is where arguably the most game-changing product of all comes in: the DSCR loan. DSCR stands for Debt Service Coverage Ratio. And here's the mind-blowing part. For a DSCR loan, the lender does not look at your personal income at all. Let me repeat that. They do not ask for your W-2s, your tax returns, or your pay stubs. Your personal income is irrelevant. So how on earth do they satisfy the ability to repay rule? They underwrite the property, not the person. The loan is based on the cash flow of the investment property itself. The lender calculates the ratio between the property's gross monthly rental income and the total monthly mortgage payment, which includes principal, interest, taxes, and insurance, what we call PITI. For example, you find a duplex you want to buy. An appraiser determines the fair market rent for the property is $4,000 a month. Your proposed total mortgage payment, or PITI, is $3,000. Your DSCR is the rent divided by the payment. 4,000 divided by 3,000 equals 1.33. Most lenders want to see a DSCR of 1.25 or higher, meaning the property's rent covers the mortgage payment with a 25% buffer. Since 1.33 is greater than 1.25, the deal works. You get the loan. Your own job and salary never even entered the equation. This allows real estate investors to scale their business based on the quality of their deals, not the limitations of their personal debt-to-income ratio. It is, quite simply, a revolution for investors. So we have bank statement loans for the self-employed, asset-qualifier loans for the wealthy and retired, and DSCR loans for the investors. These aren't shady, undocumented loans from 2006. They are highly sophisticated financial tools, each designed to serve a specific type of borrower that the traditional system fails. They all adhere to the law by documenting a borrower's ability to repay. They just use a different, more appropriate set of documents to do it. But this all sounds a little too good to be true, doesn't it? If these loans are so great, why isn't everyone getting one? Who are these lenders, tucked away in the corners of the financial world? And what's the catch? Because in finance there is always a catch. Higher interest rates? Enormous down payments? Hidden fees? The answers to those questions reveal the true trade-offs of stepping outside the world of conventional lending. And that's exactly where we're going next. The first and most fundamental trade-off is the interest rate. There is no way around it. A loan that requires less documentation from you will always, without exception, come with a higher interest rate than a conventional mortgage. It's not personal, it's just math. From a lender's perspective, information equals safety. A W-2, 2 years of tax returns, and a stable salary, that's a clear, predictable picture. It reduces their risk. When you take away that picture and replace it with 12 months of bank statements, you're introducing uncertainty. Is that income stable? Will it continue? The lender is taking a bigger gamble on you, and they expect to be compensated for that increased risk. Think of it like car insurance. A driver with a 20-year clean record pays a much lower premium than a 17-year-old who just got their license. The 17-year-old might be the safest driver in the world, but the insurance company doesn't have the data to prove it. They only see the risk. It's the same with lending. A no-doc borrower, in the eyes of the lender, is the 17-year-old driver. So what does this look like in real numbers? Well, if the prime rate for a conventional 30-year fixed mortgage for a borrower with excellent credit is, say, 7%, a bank statement loan for that very same person could easily be 9%. Or 10%. In some cases, even higher. That 2 or 3 point difference might not sound like much, but on a $500,000 loan over 30 years, it's astronomical. We're talking about over $100,000 in extra interest payments. It is a massive premium to pay for the convenience of not showing your tax returns. But the interest rate is just the opening act. The main event, the barrier that stops most people in their tracks, is the down payment. If you're used to hearing about FHA loans with 3.5% down, or even conventional loans with 5 or 10% down, you need to erase those numbers from your mind. They do not exist in this universe. In the world of alternative lending, the lender needs you to have serious skin in the game. Since they can't fully verify your ability to pay month after month based on traditional metrics, they protect themselves on the back end. They want to ensure that if you default and they have to foreclose, there is so much equity in the property that they are guaranteed to get their money back. And how do they guarantee that? By requiring a colossal down payment. We're not talking 20%. 20% is often the absolute best-case scenario minimum. For most no-doc or bank statement loans, you should expect to be asked for 25%, 30%, or even 35% down. And if you're buying an investment property, get ready for 40% down. Think about that. On a $600,000 home, a 35% down payment is $210,000 in cash, plus closing costs. This creates a fascinating paradox. These loans are designed for people who have trouble proving their income on paper, like business owners or freelancers, yet they require you to be incredibly cash-rich. You have to have a massive amount of liquid capital saved up just to get in the door. This single requirement immediately filters out 99% of potential borrowers. It's not a tool for people struggling to get by. It's a tool for people who are asset-rich but paper-poor. So you've accepted the higher rate, and you've managed to pile up a dragon's hoard of cash for the down payment. You're clear, right? Not so fast. The third trade-off is the world of fees and points. The closing costs on non-conventional loans are almost always higher. The origination fees, the fee the lender charges just for creating the loan, can be a full percentage point or more higher than on a standard mortgage. You might also be required to pay points to buy down your interest rate, which is essentially prepaying interest to get a slightly less painful monthly payment. But that's more cash you need up front. And then there's a nasty little clause that was supposed to have died after the 2008 crash, but it still lurks in the shadows of the non-QM world: the prepayment penalty. A prepayment penalty is a fee a lender can charge you if you pay off your mortgage too early, usually within the first 3 to 5 years. Why would they do this? Because they make their money from the interest you pay over time. If you get a 10% interest loan and then, a year later, your income situation normalizes and you refinance into a 7% conventional loan, the lender loses out on all that future high-interest profit. The prepayment penalty is their insurance policy against that. It can be a fee equal to 6 months of interest or a set percentage of the loan balance. It's a financial handcuff designed to keep you in that expensive loan for a set period, making it much harder and more costly to escape. So why? Why are all these conditions so much harsher? The answer lies in the legal and regulatory landscape that was born from the ashes of the 2008 financial crisis. A piece of legislation called the Dodd-Frank Act created something called the Ability to Repay Rule. This rule requires lenders to make a good faith effort to determine that you, the borrower, can actually afford to pay back the loan. To give lenders a clear path, the government created a category of loans called qualified mortgages, or QM loans. If a loan meets all the QM criteria, like verifying income with W-2s and tax returns, and keeping debt-to-income ratios below a certain threshold, the lender gets legal protection. They are presumed to have satisfied the ability to repay rule. But these no-doc and bank statement loans? They are, by definition, non-QM loans. They exist outside of that safe harbor. The lender does not have that same legal protection. They are taking on significantly more regulatory risk in addition to the financial risk. If you default, it's much easier for you to sue the lender and claim they gave you a loan they knew you couldn't afford. So the higher interest rates, the massive down payments, the extra fees, the prepayment penalties, it's not just about greed. It's the lender's armor. It's the price they charge for being willing to step outside the government-approved lending box. They are building a fortress of cash and clauses around the loan to protect themselves from the increased financial and legal danger of doing business with you. It sounds like a terrible deal. A financial trap designed to squeeze every last dollar out of someone who can't walk the conventional path. A higher rate that bleeds you with interest, a down payment that drains your life savings, and penalties that lock you in. At this point, you're probably asking the logical question: who in their right mind would ever sign up for this? Why would anyone willingly walk into this financial minefield? And that is the perfect question, because the answer reveals that these loans for the right person in the right situation aren't a trap at all. They are a key, a strategic weapon used by some of the most savvy real estate investors and entrepreneurs in the country. And figuring out if you are one of them is the most important part of this entire story. So, who are these people? Who are the savvy operators using a tool that so many others fear? The answer isn't a single type of person. It's a collection of individuals who share one common trait. Their financial life doesn't fit neatly into the tiny, rigid box that traditional lenders use for underwriting. Let's pull back the curtain and meet the ideal candidates for today's non-qualified mortgages. See if you recognize yourself in any of them. First and most common is the entrepreneur. Let's call her Jessica. Jessica owns a thriving e-commerce business. Last year, her company did over $1 million in gross revenue. She's successful by any measure. She pays herself a reasonable salary, but like any smart business owner, she and her accountant work diligently to minimize her taxable income. They write off everything they legally can: inventory, marketing costs, software subscriptions, a portion of her home office, business travel. When it comes time to file her taxes, her adjusted gross income, the number on the bottom line of her tax return, is $80,000. Jessica goes to a big bank to get a mortgage for her dream home. She walks in with bank statements showing hundreds of thousands of dollars flowing through her accounts every month. She has a perfect credit score. She has a hefty down payment saved up. She feels confident. The loan officer looks at her application, smiles, and then pulls up her tax returns. The smile vanishes. To the bank's underwriting software, Jessica doesn't make $1 million a year. She makes $80,000. Based on their formulas, she can barely afford a small condo, let alone the house she wants. She is, in their eyes, a risk. This is the entrepreneur's paradox. The very strategies that make you a brilliant business owner make you look like a deadbeat borrower to a conventional lender. This is where the modern no-doc loan, specifically a bank statement loan, becomes Jessica's superpower. A non-QM lender looks at Jessica and sees reality. They say, "Forget the tax returns. Show us your last 12 or 24 months of business bank statements." They don't care about her write-offs. They care about her cash flow. They use a formula to determine her real, usable monthly income based on the consistent deposits into her account. Suddenly, the lender sees the true health of her business. They see the $1 million in revenue, not the $80,000 in taxable income. For Jessica, this loan isn't a shady shortcut. It's the only path that acknowledges how a real modern business actually works. It allows her to leverage the success of her business to improve her personal life, without having to intentionally overpay on taxes just to satisfy a lender's outdated checklist. Next, meet the real estate investor. Let's call him David. David owns 6 rental properties. He's a pro. His goal is to acquire 2 more properties this year. The problem is, every time he goes to a conventional bank, the process is a nightmare. They want tax returns for him, tax returns for his LLC, detailed profit and loss statements for every single one of his 6 existing properties, copies of every lease agreement. The paperwork is a mountain. The underwriting process takes months, and in a hot real estate market, that's a death sentence. By the time the bank approves his loan, the property he wanted is long gone. Furthermore, his debt-to-income ratio on paper looks terrible to a traditional lender. They see 6 mortgages and their computers flash red. Even if all 6 properties are generating positive cash flow, they see the debt, but they struggle to properly account for the rental income in their rigid calculations. For David, the game changer is a specific type of non-QM loan called a DSCR loan. That stands for debt service coverage ratio, and this is pure genius. A DSCR loan almost completely ignores David's personal income. The lender doesn't ask for his tax returns. They don't care about his W-2 job if he even has one. They care about one thing and one thing only. Does the property he is buying generate enough income to cover its own expenses? They'll look at the potential rent for the new property. Let's say it's $3,000 a month. Then they'll calculate the total monthly payment for the new mortgage, including principal, interest, taxes, and insurance. Let's say that's $2,200. They divide the rent by the payment. $3,000 divided by $2,200 is about 1.36. This is the debt service coverage ratio. As long as that number is above a certain threshold, usually 1.25, the loan is approved. The property pays for itself. It's a self-sustaining investment. For David, DSCR loans are more than a tool. They are the engine of his entire business. They allow him to scale his portfolio based on the quality of his deals, not on the limitations of his personal tax returns. He can close deals in weeks, not months, competing with cash buyers because his financing is so streamlined and reliable. Then there's the gig economy pro. This is Maria. Maria is a top-tier freelance software developer and a part-time YouTube creator. Last year, she made $250,000. But it didn't come in neat, bi-weekly paychecks. She received a dozen different 1099 forms from various clients. Some months she billed $80,000 for a huge project. Other months, while she was looking for the next gig, she might have only billed $5,000. Her income chart looks like a mountain range. When Maria goes to a traditional lender, they see instability. They see risk. They take her last 2 years of 1099 income, average it all out, and then often only count a percentage of that average because it's not stable. They don't understand that in her world, this lumpiness is completely normal. The high-earning months more than make up for the slower ones. She, like Jessica the entrepreneur, is a prime candidate for a bank statement loan. A non-QM lender can look at her personal bank statements, see the massive deposits, and understand the true picture of her earning power. They provide a financing solution built for the 21st century workforce, for the millions of Americans who no longer earn a living in the traditional 9-to-5 model. Finally, there's a smaller but crucial group: foreign nationals, recent immigrants, or retirees with significant assets but little documented income. Think of a retiree who lives off dividends from a large stock portfolio. Their tax returns might show very little earned income, but they are sitting on millions in assets. Or a software engineer from Germany who just moved to the US for a new job. He has a high salary and perfect credit in his home country, but no U.S. credit history or tax filings. For these individuals, an asset-based loan or a foreign national loan, both types of non-QM products, can be the only viable option to purchase a home. These loans look at assets, not income, to qualify the borrower, opening a door that the conventional system slams shut. So if you see yourself in any of these profiles, the business owner who is penalized for smart tax strategy, the investor who needs speed and scale, the freelancer whose income doesn't fit a 9-to-5 mold, or anyone whose financial story is more complex than a W-2, you're probably feeling a rush of excitement. A door you thought was locked forever might just be creaking open. But before you sprint through it, you have to understand the price of admission. These loans aren't a free lunch. They come with their own set of rules, their own risks, and their own costs. And ignoring them, well, that's how you turn a strategic weapon back into a trap. So let's talk about that price of admission. What does it actually cost to step into this world of alternative documentation? The first thing you have to understand is that the term no-doc mortgage is, in 2024, mostly a ghost. It's a marketing term, a shadow of its former self. The Wild West of 2006, where you could walk into a lender, state your income was $1 million a year with a wink and a nod, and walk out with a check. That's over. The Dodd-Frank Act put a stake through the heart of that specific monster. What rose from the ashes is something smarter, more nuanced, and frankly more stable. It's not a no-doc world anymore. It's an alt-doc world. Alternative documentation. The core principle isn't about ignoring the rules. It's about using a different rulebook. Lenders still have to satisfy a core requirement called the ability to repay rule. They must make a good faith effort to determine you can actually afford the loan they're giving you. They can't just take your word for it. But how they determine that ability, that's where the game has changed. They're not just looking at your W-2 and your tax returns anymore. They've developed specialized tools for specialized borrowers. Think of it like this. A standard mortgage is like trying to measure a carpenter's skill by only looking at their high school report card. It might be useful for some, but it completely misses the point for a master craftsman whose real proof of skill is in the houses they've built, not the algebra test they took 10 years ago. Alt-doc loans are about looking at the houses. So let's meet the new players on the field. The first, and by far the most common, is the bank statement loan. This is the weapon of choice for the modern entrepreneur. The freelancer, the gig worker, the small business owner. These are people whose tax returns are a work of art, meticulously crafted by their accountant to legally minimize their tax burden. They have write-offs for everything. The home office, the business mileage, the client dinners, the new laptop. The result is that their official taxable income might be $60,000 a year. But the actual cash flowing through their business and personal bank accounts could be 2, 3, or 4 times that. A conventional lender looks at the $60,000 figure and says, "Sorry, you don't qualify." The alt-doc lender says, "Show me your bank statements." They'll typically ask for 12 or 24 months of statements. They're not looking for individual expenses. They're looking at the big picture, the total volume of deposits. They have a formula. They'll add up all the deposits over that period, and then they'll apply an expense ratio. For a service-based business, they might assume your expenses are 30%. For a business that sells physical goods, maybe it's 50% or 60%. They subtract this assumed expense ratio from your total deposits, and what's left is the income figure they use to qualify you for the loan. So if you deposited $300,000 into your business account over 12 months, and the lender uses a 50% expense ratio, they don't see you as someone who makes what your tax return says. They see you as a borrower with an annual income of $150,000. Suddenly, a whole new world of properties opens up to you. This is the key that unlocks the door for millions of self-employed Americans. But here's the price of admission. The interest rates on bank statement loans are almost always higher than a conventional loan. Think 1 to 3 percentage points higher. And the down payment? Forget about 3% down. You'll almost certainly need 20%, sometimes 25% or more. And your credit score needs to be solid. They're replacing income documentation with a larger down payment and a higher rate. They're mitigating their risk. Next up is a tool built for a completely different person, the real estate investor. This is the DSCR loan. Debt, service, coverage, ratio. Those words sound complicated, but the concept is beautifully simple. A DSCR loan doesn't care about your personal income. You could be officially unemployed. You could have $0 on your tax return. It doesn't matter. The loan isn't being approved based on you. It's being approved based on the property you're buying. The lender asks one simple question. Will this investment property generate enough rental income to cover its own expenses? The main expense, of course, is the mortgage payment itself, the principal, interest, taxes, and insurance or PITI. They'll look at market rate rents in the area for a similar property. Let's say the total monthly PITI for the new property is going to be $2,000. And let's say a market analysis shows it can be rented for $2,500 a month. To get the DSCR, you just divide the rent by the PITI. In this case, $2,500 divided by $2,000 is 1.25. That's your debt service coverage ratio. Most lenders want to see a DSCR of 1.25 or higher. This means the property generates 25% more in income than it costs to carry. If it does, you're likely to be approved. Your personal W-2 is irrelevant. Your tax returns are irrelevant. It is the single most powerful tool for investors looking to scale their portfolio without having to repeatedly document their complex, multi-property income streams for every single purchase. The price of admission here? DSCR loans are exclusively for investment properties, not your primary residence. And just like bank statement loans, you can expect higher rates and a down payment requirement of at least 20 to 25%. They are a business loan for a business asset. Finally, we have the third major player designed for the asset-rich but income-poor. This is the asset-based loan, sometimes called an asset depletion or asset qualification loan. Imagine a retiree. They've worked their whole life and have $2 million saved in a brokerage account. They don't have a job anymore. Their traditional income might be a small pension or Social Security, not nearly enough to qualify for $1 million home. Or think of a tech founder who just sold their company. They're sitting on millions in cash and stocks, but haven't started their next venture yet, so they have no income. For these individuals, an asset-based loan is the solution. A lender will look at their total eligible assets, stocks, bonds, mutual funds, retirement accounts, and calculate a monthly income from that pile of money. The formula varies, but a common method is to take the total asset value and divide it by a set number of months, say 360 months, which is 30 years. So, for that retiree with $2 million, a lender might divide that by 360 and determine they have a qualifying income of about $5,500 a month. They can use this figure, plus any other income they have, to qualify for the mortgage. This allows them to leverage their wealth to buy real estate without having to liquidate their assets, which could trigger a massive tax bill. They're using the potential of their portfolio to secure the loan. The price? You guessed it. Higher rates, a substantial down payment, and you need to have a very significant amount of liquid assets for this to even be an option. Lenders are also very particular about which assets they'll consider. They want stable, easily valued assets, like publicly traded stocks and bonds. So you've got the bank statement loan for the entrepreneur, the DSCR loan for the investor, and the asset-based loan for the wealthy. Three powerful keys for three very different doors. These aren't the reckless, anything-goes loans of the past. They are structured, risk-calculated instruments designed for borrowers who are perfectly creditworthy, but whose financial lives don't fit into the neat little box of a W-2 employee. But knowing which key you need is only half the battle. The other half is finding the right locksmith. Who are these lenders, anyway? Are they the same big banks you see on every corner? Or are they hiding in the shadows of the financial world? The answer is more complex and more important than you might think. Let's get one thing straight right away. You are not walking into a Chase, a Bank of America, or a Wells Fargo to get a modern no-doc or low-doc mortgage. Those Wall Street titans, the ones with gleaming skyscrapers and commercials during the Super Bowl, they live in a completely different world. Their world is governed by a set of incredibly strict rules, a financial rulebook written in the wake of the 2008 crisis. It's a world of what we call qualified mortgages, or QM loans. Think of a QM loan as the government-approved, safety-inspected, one-size-fits-all mortgage. To earn that qualified mortgage stamp, a loan has to check a very specific set of boxes. The most important box? The lender must make a good faith effort to determine that the borrower has the ability to repay the loan. And how do they do that? By verifying income using very traditional, very specific documents. W-2s, pay stubs, tax returns, the very documents that our freelance graphic designer, our seasoned contractor, or our successful e-commerce entrepreneur often can't produce in a way that fits neatly into the bank's algorithm. The big banks love QM loans because they offer a legal safe harbor. If they issue a QM loan and the borrower defaults, it's much harder for that borrower to sue the bank claiming they were given a loan they couldn't afford. It's a liability shield. So, for these massive institutions that process millions of applications, it's all about standardization, efficiency, and minimizing risk. They're running a factory, not a custom tailor shop. Your unique financial story, with its fluctuating income and complex deductions, is a wrench in their assembly line. They're not equipped or frankly interested in dealing with it. They will politely show you the door. So, if the giants won't play, who will? Who are these locksmiths willing to craft a custom key? You have to venture beyond the brightly lit world of QM loans and into the realm of non-QM. Now that name, non-qualified mortgage, sounds a little scary, doesn't it? It sounds unofficial, maybe even a little shady. But that's a misunderstanding. Non-QM doesn't mean bad or subprime or dangerous. It simply means the loan doesn't check every single box on the government's QM checklist. That's it. It's the financial equivalent of coloring outside the lines. And it's in this creative, flexible space that no-doc and low-doc mortgages thrive. The lenders who operate here are a different breed. They aren't massive, publicly traded behemoths. They are specialists. They are niche players who have built their entire business model around understanding the borrowers the big banks turn away. Let's break down who these players are. The most common and accessible route for most people is through a mortgage broker who works with wholesale lenders. This is a critical distinction. A mortgage broker is your guide, your advocate. They don't work for one specific bank. They work for you. Think of them like an independent insurance agent who can shop around with dozens of companies to find you the best policy. A good mortgage broker has relationships with a wide array of lenders, including these specialized wholesale lenders who offer non-QM products. These wholesale lenders are the behind-the-scenes powerhouses. You've probably never heard of their names. Companies like Angel Oak Mortgage Solutions, or Carrington Mortgage Services, or NewFi Wholesale. They don't have retail branches on street corners. They don't advertise on TV. They operate exclusively through a network of brokers. Their entire expertise is in underwriting complex files. They have teams of underwriters who know how to analyze bank statements, who understand the cash flow of a small business, and who are comfortable with asset-based lending. They've built the systems and hired the talent to do the detailed, manual work that the big banks have automated away. So your first step isn't to find a lender. It's to find a great mortgage broker who specializes in non-QM loans. They hold the map to this hidden world. The second category of lender is the world of private money and hard money. This is where things get even more specialized and often more expensive. These aren't typically institutions at all. A private lender could be a wealthy individual, a family office, or a small group of investors who have pooled their capital. They're essentially acting as the bank themselves. They use their own money to fund loans, and because of that, they make their own rules. They are the ultimate in flexibility. If the deal makes sense to them, they'll fund it. They can move incredibly fast, sometimes closing a loan in a matter of days, not weeks or months. Hard money lenders are a subset of private lenders, typically focused on short-term, asset-based loans, often for real estate investors flipping a property. For them, the property itself is the main consideration. If you have a huge down payment and the property is a great value, they may not care about your income at all. The trade-off for this speed and flexibility? Cost. Private and hard money loans almost always come with significantly higher interest rates and upfront fees, often called points. They're not usually a long-term solution for a primary residence, but for a unique investment opportunity or a bridge to more permanent financing, they can be an invaluable tool. The third, and often overlooked, category is portfolio lenders. This is a hidden gem. Who are they? They're often your local community banks and credit unions. Now wait a minute, I know I said banks don't do these loans. I was talking about the big national banks. Smaller institutions sometimes operate differently. Most lenders, big and small, package up the mortgages they create and sell them on the secondary market to investors like Fannie Mae and Freddie Mac. This frees up their capital to make more loans. But a portfolio lender does something different. They keep the loan in portfolio. They hold on to it. They own it and they service it for the life of the loan. And because they aren't selling it, they don't have to follow Fannie Mae's or Freddie Mac's strict QM rules. They can use their own common sense underwriting. If you're a longtime member of a local credit union, and you're a respected local business owner, the loan officer might actually know you. They can look at your entire financial picture, your standing in the community, and the specifics of your business and make a judgment call. They can create a custom-tailored loan that makes sense for both you and them. This relationship-based lending is a throwback to an older era of banking, and for the right borrower, it can be the absolute best option, often with more competitive rates than a non-QM specialist. So you have the wholesale lenders access through brokers, the fast but expensive private lenders, and the relationship-focused portfolio lenders. These are your locksmiths, but knowing they exist is only half the battle. In a market with fewer regulations, the burden of due diligence falls more heavily on you, the borrower. You have to know how to spot a master craftsman from a charlatan. When you start talking to a potential broker or lender, you need to interview them as much as they're interviewing you. Ask them directly. How many non-QM loans have you closed in the last year? You want someone who lives and breathes this stuff, not someone who dabbles in it once in a blue moon. Ask them to explain their process for bank statement or asset depletion loans in detail. If they can't explain it clearly and confidently, that's a massive red flag. Ask for a full breakdown of all potential fees up front. The non-QM world can have higher fees, but they should be transparent about them. There should be no surprises at the closing table. And finally, ask for references or look for online reviews specifically from other self-employed borrowers or real estate investors. Their experiences will tell you everything you need to know. Finding the right lender is not about a Google search for no-doc mortgage. It's about finding the right human being, a knowledgeable broker or a flexible loan officer who understands your story. They are out there, operating in the spaces the big banks ignore. They are the specialists who recognize that a neat and tidy W-2 is not the only measure of a person's financial strength. But this now raises the ultimate question. We know who the players are. We know what kind of borrower needs them. But what does it actually take to get one of these loans approved? What are the real-world requirements you need to meet to turn that key and finally unlock the door to your next property? Let's pull back the curtain. Forget the myths and the whispers of liar loans from a bygone era. Getting a modern non-QM or no-doc mortgage isn't about walking into a bank with a wink and a handshake. It's a calculated, data-driven process. And while they don't ask for your tax returns, they scrutinize 3 other areas with an intensity that might surprise you. Think of it as a 3-legged stool. If any one of these legs is weak, the whole deal collapses. The first and arguably most important leg is your credit score. In a world where a lender can't see your W-2s or tax returns, your credit history becomes your financial autobiography. It's the only official record they have of your character as a borrower. It tells them, do you pay your bills on time? Do you manage debt responsibly? Are you a reliable risk? For a standard conventional loan, you might squeak by with a lower score. But for a non-QM loan, the bar is set significantly higher. Most lenders in this space are looking for a minimum credit score of 660, and many prefer to see you north of 700, even 720 to get their best terms. A high credit score is your entry ticket. It's the non-negotiable price of admission that tells the lender, okay, this person is serious. Let's look at the next piece of the puzzle. Without it, the conversation is over before it even begins. The second leg of the stool is the down payment. This is all about skin in the game. The lender is taking a perceived risk by not verifying your income in the traditional way. So they need you to share in that risk. And the most tangible way you can do that is by putting down a substantial amount of your own money. Forget the 3.5% down FHA loans or the 5% conventional options. For most non-QM loans, you should be prepared for a down payment of at least 20%. And frankly, 25% to 30% is far more common, especially if you want a better interest rate or if your credit score is on the lower end of their acceptable range. Think about the psychology here. If a borrower puts down 25%, that's $100,000 on a $400,000 property. They are highly motivated to never miss a payment. They have too much to lose. This large down payment immediately reduces the lender's loan-to-value ratio, or LTV, creating an instant equity cushion. If the market dips or you run into trouble, that cushion protects the lender from taking a loss. A big down payment proves you have significant capital, that you're financially stable, and that you are just as invested in the success of this loan as they are. The third leg, which supports everything else, is your assets and reserves. This is the lender's safety net. They need to see that you not only have the money for the down payment and closing costs, but that you also have a deep well of liquid cash left over. These are called reserves. They want to know that if your business has a slow month or a client pays late, you won't immediately default on the mortgage. The standard requirement is typically 6 to 12 months of pity. That's your full monthly payment. Principal, interest, taxes, and insurance. So if your total mortgage payment is $4,000 a month, they'll want to see an extra $24,000 to $48,000 sitting in your bank account after you've paid your down payment and closing costs. This money can be in checking, savings, or brokerage accounts. Sometimes they'll even consider a portion of your retirement accounts. They verify this by looking at your bank statements for the last 2 to 6 months, confirming that the money is seasoned, meaning it didn't just appear out of nowhere last week. This deep reserve requirement is the final proof point that you are a low-risk borrower, despite your unconventional income situation. Now, once you clear those 3 fundamental hurdles, strong credit, a big down payment, and deep reserves, the path diverges depending on the specific type of non-QM loan you're seeking. This is where it gets really interesting. Let's start with the most common one, the bank statement loan. This is the holy grail for self-employed individuals and small business owners. Instead of tax returns, the lender will ask for 12 or, more commonly, 24 months of your business or personal bank statements. They aren't reading every line item to see how much you spend on coffee. They are performing a cash flow analysis. An underwriter will meticulously go through every single deposit for the last 2 years. They'll add up all the eligible deposits and divide by 24 to get your average monthly income. But here's the critical detail. They don't use 100% of that number. If it's a business bank account, they'll typically apply what's called an expense factor, assuming that a certain percentage of your revenue goes to business expenses. A common expense factor is 50%. So if you can show you have an average of $20,000 a month deposited into your business account, the lender will qualify you using a monthly income of $10,000. They are essentially creating a synthetic, common-sense version of your net income, using your real-world cash flow as the evidence. Next, you have the asset qualifier or asset depletion loan. This is designed for a completely different type of borrower. Think of a wealthy retiree, an early crypto investor, or someone who just sold a company. They might have millions of dollars in stocks, bonds, and cash, but very little traditional income to show for it. For these individuals, the lender uses a simple but powerful formula. They will verify your total liquid assets. Let's say you have $2 million in a brokerage account. They will then deplete that amount over a set period, say 60 or 120 months, to create a qualifying monthly income. So $2 million divided by 60 months would equate to a qualifying income of over $33,000 a month, more than enough to qualify for a substantial mortgage, all without ever showing a single pay stub. Finally, there's the loan that is absolutely exploding in popularity among real estate investors, the DSCR loan. DSCR stands for Debt Service Coverage Ratio, and it's a game changer because this loan doesn't care about your personal income at all. You could be unemployed and it wouldn't matter. The only thing the lender cares about is the property's ability to generate its own income. Here's how it works. The lender gets an appraiser to determine the property's fair market rent. Let's say that's $3,000 a month. Then they calculate the property's total monthly mortgage payment, the PITI. Let's say that's $2,500. They then divide the rental income by the PITI. In this case, $3,000 divided by $2,500 gives you a DSCR of 1.2. Most lenders want to see a ratio of at least 1.0, which means the property's rent exactly covers the mortgage payment. It breaks even. But many prefer a DSCR of 1.25 or higher, which shows the property not only pays for itself but also generates a positive cash flow, creating a safety buffer. For an investor, this is revolutionary. It allows them to scale their portfolio based on the merit of their deals, not on the limitations of their personal W-2 income. So you see, getting a non-QM loan isn't a loophole. It's a highly structured, alternative path to financing. It's a system built on the pillars of excellent credit, significant personal investment, and verifiable liquid assets. The requirements aren't lower than a conventional loan. In many ways, they are far more demanding. They are simply different. They are designed to measure risk and ability to repay using a different set of tools for a different kind of borrower. The system works. It's logical. It's methodical. But knowing what it takes to get one is only half the battle. The ultimate question remains. Now that you know the price of entry, you have to ask, is it worth it? Are these loans actually a good idea for you? What are the hidden drawbacks, the higher costs, and the critical red flags that might tell you to run in the other direction? The allure is undeniable. A mortgage without the soul-crushing paperwork, the endless requests for tax returns, pay stubs, and bank statements. It sounds like a dream, a VIP pass to the front of the home buying line. But this convenience, this speed, comes at a steep and often hidden price. This isn't a free lunch. It's a high-interest, high-stakes transaction where the lender is betting against your complexity. And you need to understand every single line of that bet before you place it. The first and most punishing drawback is the interest rate. It's not a little higher, It's significantly higher. Think of it from the lender's perspective. A conventional loan is a safe bet. They've seen your W-2s, your tax returns, your savings. They have a clear, documented picture of your ability to repay. You are a known quantity. But with a non-QM loan, especially one that doesn't verify income, you are a mystery. They know you have assets, they know you have a great credit score, but they can't see the engine of your finances, the cash flow. To compensate for that unknown, for that increased risk, they charge a premium. A massive one. Let's put numbers on this. If a prime borrower can get a conventional 30-year fixed mortgage at say 6.5%, a borrower getting a non-QM loan might be looking at 8.5%, 9.5%, or even higher depending on their specific profile. 2 or 3 percentage points might not sound like a lot, but on a mortgage it's a financial earthquake. On a $500,000 loan, a 6.5% rate gives you a monthly principal and interest payment of about $3,160. At 8.5%, that same loan costs you $3,844 a month. That's nearly $700 more every single month. Over the 30-year life of the loan, you'd pay over $250,000 more in interest. Let me repeat that, over $250,000 more just for the privilege of not showing your paperwork. That convenience fee is the price of a whole other house in some parts of the country. Next up is the down payment, which we touched on before. It's not just a requirement, it's a massive financial gatekeeper. The days of getting a no-doc loan with 5% down are a ghost of 2008. Today, lenders demand serious skin in the game. We're talking a minimum of 20%, and more commonly 25% to 40%. For that same $500,000 house, a 30% down payment is $150,000 in cash you need at the closing table. This creates a strange paradox. These loans, often sought by people whose income is hard to prove, require a colossal amount of easily provable cash up front. It immediately filters out anyone who isn't already sitting on a substantial pile of liquid assets. But the costs don't stop there. Lenders often charge higher origination fees and points on these non-QM loans. A point is equal to 1% of the loan amount, paid up front to the lender to buy down your interest rate or, in many cases, to simply increase the lender's profit on a riskier deal. While a conventional loan might have fees around 1%, a non-QM loan could have fees of 2%, 3%, or more. On our $500,000 loan, that's an extra $5,000 to $10,000 in closing costs. And this brings us to one of the most dangerous red flags, a relic of the subprime era that still exists in the non-QM world: the prepayment penalty. This is a clause buried in your loan documents that states if you pay off your mortgage too early, usually within the first 3 to 5 years, you owe the lender a penalty fee. Why would they do this? Because their entire profit model is based on collecting that high interest rate from you over several years. If you get the loan, fix your documentation issues, and then refinance into a cheaper, conventional loan 6 months later, the lender loses all their projected profit. The prepayment penalty is their insurance policy. It effectively traps you in that high-interest loan, preventing you from escaping to a better deal, even when your financial situation improves. If you see a prepayment penalty clause, you need to understand exactly how it works and have a very, very good reason for accepting it. So, when does this tool actually make sense? Who is the ideal candidate for a loan with all these expensive strings attached? It's not the person who is trying to stretch to afford a house they can't really pay for. That's the 2008 recipe for disaster. Today, the ideal candidate is someone who is financially strong, but document poor. Think of a successful entrepreneur who has been in business for 18 months. They're making a fortune, but they don't have the 2-year tax history required for a conventional loan. They have a 780 credit score and $1 million in the bank. For them, paying a higher interest rate for a couple of years until they can show that 2-year history and refinance is simply a business expense, a convenience fee, to get into their dream home now instead of later. Or consider the savvy real estate investor buying a rental property. They might use a DSCR loan, a type of non-QM loan where the lender qualifies the loan based on the property's expected rental income, not the borrower's personal salary. If the rent is going to be $4,000 a month and the total mortgage payment is $2,800, the lender sees a safe, cash-flowing asset. They don't need to see the investor's W-2. It could also be a foreign national with a high net worth and significant assets overseas, but no U.S. credit history or tax returns. Or a retiree who has millions in an investment portfolio, but a very low taxable income. These are people who can easily afford the payments and have massive assets to back it up. The no-doc loan isn't a lifeline for them. It's a logistical shortcut. The critical takeaway is this. Modern no-doc and non-QM loans are not for people who are financially weak. They are for people who are financially strong in unconventional ways. The high down payment and asset requirements are the guardrails designed to keep us from repeating the mistakes of the past. So, as you navigate this world, what are the red flags that should have you running for the hills? First, pressure. Any lender or broker who creates a false sense of urgency, telling you an offer is only good right now, and rushing you to sign without reading every single word, is not on your side. Second, a lack of clarity. If they can't explain every fee, every term, and how an adjustable rate might change in simple language you understand, walk away. Confusion is a sales tactic. Third, promises that sound too good to be true. No income, no assets, no problem is not a loan offer. It's the opening line of a tragedy. Ultimately, the ghost of the no-doc mortgage has taught us a powerful lesson. The problem was never the tool itself, but how it was misused. It was sold as an easy button for homeownership, a magical key for anyone who wanted a house, regardless of their ability to pay. The reality is that it's a specialized instrument, a surgeon's scalpel, designed for a very specific type of financial surgery. In the hands of a qualified person, a financially sound borrower with a legitimate documentation problem, it can be incredibly effective. But in the hands of someone trying to bypass the fundamental rules of finance, it can lead to foreclosure and financial ruin. So, do no-doc mortgages still exist? Yes, but they wear a new suit of armor called the non-QM loan, built with the steel guardrails of ability to repay rules. They are no longer a shortcut for the unqualified, but a pathway for the unconventional. The question you must ask yourself isn't just, can I get this loan? It's, should I? Can you truly afford not just the monthly payment today, but the enormous long-term cost of that convenience? Because in the high-stakes world of real estate, the foundation of your financial future can't be built on shortcuts or loopholes. It must be built on the bedrock of reality. Understand the tool, know the true price, and make your decision not with wishful thinking, but with cold, hard math. That is the only path to a home that is a blessing, not a burden.